There was a time when power was measured in miles. Empires rose by marching armies across frontiers, planting flags in distant soil, and drawing bold red lines across maps. Land was wealth. Territory meant tribute, manpower, and grain. From Rome to Spain, dominion depended upon physical control. But by the late 17th century, something began to change. The most powerful empire in the modern world would not be built solely on land. It would be built on ledgers. Britain's ascent marked a profound shift in the history of money and power. Unlike the sprawling land empires of antiquity, Britain was a comparatively small island kingdom on the edge of Europe. It did not possess the population of France nor the continental depth of Russia. Yet within 2 centuries, it would preside over the largest empire the world had ever seen. The question is not simply how Britain acquired territory. The deeper question is how it learned to control wealth itself, and why that mattered more than land. The late 17th century was an age of almost constant warfare. European powers strained their treasuries fighting for dynastic survival and commercial advantage. Traditional methods of financing conflict, heavy taxation and short-term loans from wealthy financiers, were reaching their limits. Estates defaulted with alarming frequency. Credit was fragile. Governments were unreliable borrowers. Military power depended on the next harvest or the next forced levy. In 1694, a decisive innovation reshaped this fragile system, the establishment of the Bank of England. Its creation was not an abstract intellectual achievement but a practical response to war finance. The English state needed funds to sustain conflict with France. In exchange for a substantial loan, a group of investors received a charter to form a bank that would manage government debt and issue notes. For the first time, national borrowing was institutionalized in a permanent, structured form. The estate's credibility was anchored not merely in royal promise, but in parliamentary authority and predictable taxation. This was the quiet revolution at the heart of UK finance history. Britain did not simply borrow, it created a funded national debt that could be traded, managed, and trusted. Government bonds became assets. Investors could buy and sell claims on the state. Public credit was transformed from a desperate necessity into a strategic tool. Where other empires relied on plunder, Britain relied on confidence. London began to evolve into something new, a financial nerve center. Capital flowed not only into warships and regiments, but into trade, shipping, and insurance. Bills of exchange circulated across continents. Credit allowed merchants to operate at distances unimaginable in earlier centuries. The pound sterling slowly gained a reputation for stability. Trust in British obligations became an invisible form of power. This transformation altered the very meaning of empire. Britain certainly acquired territory in North America, the Caribbean, India, and beyond. But territorial expansion was increasingly supported, and sometimes even preceded, by financial integration. Trade networks tied distant colonies into a system centered on London. Debt and credit linked foreign governments and merchants to British markets. Wealth could be influenced without direct annexation. By the 18th century, the foundations of the British Empire economy were no longer confined to naval dominance or colonial administration. They rested upon the management of money itself. Control of wealth, through bonds, currency, and capital markets, began to matter as much as control of land. The empire was becoming less a map of colored territories and more a web of financial relationships. This shift would prove decisive. For the first time in history, an empire discovered that it could project influence not merely through soldiers and governors, but through bankers and balance sheets. The real frontier was no longer geographical. It was monetary. And in mastering that frontier, Britain reshaped the global order. If Britain's transformation into a financial power began with the stabilization of public credit, its true strength lay in how that credit was engineered and deployed. The machinery of empire was no longer powered solely by cannon and convoy. It was powered by debt, structured, tradable, and sustained by confidence. The cornerstone of this system was the funded national debt. Unlike earlier monarchies that relied on short-term, often coercive loans, the British state consolidated its borrowings into long-term bonds. These securities, issued under parliamentary authority, paid regular interest funded by predictable taxation. Investors were not lending to a king whose promises might dissolve with dynastic change, they were lending to a constitutional system. This distinction mattered profoundly. Credibility reduced borrowing costs. Lower borrowing costs meant greater military endurance. In prolonged wars against France in the 18th century, Britain could outspend its rivals not because it was richer in land, but because it was richer in trust. Government bonds became tradable instruments in London's expanding financial markets. They could be bought, sold, and used as collateral. This liquidity transformed state debt into a foundation for private finance. Banks and merchant houses operated in an environment where sovereign obligations were considered reliable assets. The boundary between public finance and private capital blurred, creating a feedback loop. Stable government credit encouraged financial growth, and financial growth reinforced the state's capacity to borrow. The pound sterling emerged as both symbol and instrument of this system. As Britain's commercial networks widened, sterling-denominated contracts became common in international trade. Merchants in Asia, the Americas, and Europe settled accounts through bills of exchange drawn on London. These bills functioned as a kind of international payment mechanism, reducing the need to move precious metals physically across oceans. London became the clearinghouse of global commerce. The value of sterling was underpinned by Britain's fiscal discipline and, later, by adherence to the gold standard in the 19th century. Confidence in the currency amplified Britain's reach far beyond its shores. The City of London's financial institutions extended this influence even further. Merchant banks arranged loans to foreign governments. British capital financed railways in Latin America, ports in the Mediterranean, and infrastructure across India and Africa. Insurance markets mitigated the risks of maritime trade, allowing shipping to operate at unprecedented scale. Risk, once a limiting factor of imperial expansion, could now be calculated, priced, and distributed. This system fostered what historians often describe as an informal empire. In many regions, Britain did not need to annex territory to exercise influence. Countries that borrowed heavily from London markets found themselves sensitive to British financial opinion. Access to credit depended on fiscal behavior. Default carried consequences not only for reputation but for trade relations and diplomatic standing. Financial leverage became a subtle instrument of policy. Influence flowed through balance sheets rather than bayonets. At the heart of these mechanisms was a simple principle: capital mobility. British investors could allocate funds globally in search of returns. In doing so, they integrated distant economies into a network centered on London. The empire was not merely territorial, it was systemic. Colonies used sterling. Foreign borrowers serviced debts in London. Insurance contracts, commodity pricing, and shipping finance were denominated within a British framework. Control of wealth replaced the need for direct rule in many contexts. Yet this system relied on discipline. The credibility of British finance demanded sound taxation, political stability, and adherence to monetary standards. The gold standard, formally adopted in the 19th century, reinforced the perception of sterling as a dependable store of value. By committing to convertibility, Britain signaled restraint. That restraint enhanced its global authority. Through these interlocking mechanisms, funded debt, tradable bonds, sterling dominance, global lending, and risk management, Britain mastered a new form of imperial power. It was quieter than conquest, less visible than annexation, but potentially more enduring. The impetus reach was now measured not only in miles of territory, but in the circulation of capital. Control of wealth had become the central architecture of power. For much of the 19th century, this financial architecture appeared unassailable. Britain stood not only as the workshop of the world, but as its banker. London discounted bills from Buenos Aires to Bombay. Sterling balances were held by central banks and merchants alike. Capital flowed outward in vast quantities, funding railways, mines, ports and public debt across continents. The British Empire economy rested upon a powerful combination, industrial strength at home and financial supremacy abroad. Yet within this apparent stability lay structural fragilities that would, over time, erode imperial dominance. The advantages were undeniable. By relying on financial influence rather than direct administration, Britain reduced the cost of maintaining order overseas. Informal empire allowed economic penetration without the expense of occupation. Profits from foreign investments bolstered domestic wealth. The pound sterling, widely accepted and trusted, lowered transaction costs and reinforced London's status as the world's clearinghouse. In many respects, Britain had achieved what earlier empires could not, global reach without constant territorial expansion. But financial empires depend on confidence, and confidence can be shaken. The system required faith in Britain's fiscal discipline, its political stability, and its commitment to monetary orthodoxy. Periodic financial crises in the 19th century, banking panics and sudden contractions of credit, revealed how quickly optimism could turn to fear. Overextension in foreign lending exposed investors to distant political risks. When borrowers faltered, London felt the strain. Debt cycles became an intrinsic feature of imperial finance: expansion, exuberance, contraction, retrenchment. The greatest test came with total war. The First World War transformed Britain from the world's foremost creditor into a heavily indebted combatant. To sustain the conflict, the government borrowed on an unprecedented scale, not only domestically but from the United States. Gold reserves were depleted. Overseas investments were liquidated to pay for imports and munitions. The financial balance that had underpinned sterling's authority began to tilt. When the war ended, Britain remained nominally victorious, but economically weakened. The interwar period exposed the depth of this vulnerability. Determined to restore pre-war financial prestige, policymakers returned sterling to the gold standard at its former parity. The decision was intended to signal continuity and strength. In practice, it imposed deflationary pressures on the domestic economy. Exports struggled under an overvalued currency. Unemployment persisted. The attempt to reclaim financial primacy strained the social fabric at home while failing to reverse the broader shift in global power. Meanwhile, the United States had emerged as the principal creditor nation. New York challenged London's supremacy. Dollar financing expanded. The center of gravity in global finance was moving westward. Britain's imperial network, once anchored securely by sterling, now faced competition from a rival currency backed by a rapidly expanding economy. The Second World War deepened the transformation. Once again, Britain financed survival through borrowing, particularly from America. By 1945, the country's reserves were exhausted, its debts immense, and its capacity to dictate global capital flows diminished. The decline of sterling as the dominant reserve currency did not occur in a single dramatic collapse. It unfolded gradually, through negotiations, devaluations, and adjustments. Yet the direction was unmistakable. The mechanisms that had once allowed Britain to project power through money were constrained by new realities. The impetus political dissolution after the war coincided with its financial recalibration. As colonies gained independence, sterling's central role within imperial trade networks weakened. What becomes clear in retrospect is that the empire did not fall because it lost land first. It lost financial command. Once Britain could no longer sustain its position as global creditor and guardian of the primary reserve currency, its broader authority diminished. Money and power had been inseparable in the age of financial empire. When control over credit, debt, and currency shifted elsewhere, so too did the balance of influence. The turning point was not marked by a battlefield surrender, but by the quiet recognition that the age of sterling supremacy had passed. The story of Britain's financial ascent and gradual decline reveals a pattern far larger than one nation's experience. Empires evolve. They begin with territory, consolidate through administration, and, at their most sophisticated stage, project influence through finance. Control of wealth becomes more efficient than control of land. Yet financial power, for all its subtlety, rests on foundations that are no less fragile than armies in the field. Britain demonstrated that mastery of public credit could multiply national strength. By institutionalizing debt, stabilizing taxation, and cultivating trust in the pound sterling, it constructed an architecture of influence that reshaped global commerce. The British Empire economy was not merely an accumulation of colonies, it was a network organized around London's markets. The real leverage lay in the ability to finance war at lower cost, to allocate capital internationally, and to denominate trade in a trusted currency. This was the essence of money and power in the modern age. Yet the same mechanisms that generate influence can, over time, generate vulnerability. A reserve currency confers privilege, lower borrowing costs, deep capital markets, geopolitical leverage. But it also imposes responsibility. Persistent deficits, excessive debt accumulation, or loss of productive competitiveness gradually erode confidence. Financial empires are sustained not by force, but by belief in stability, convertibility, and discipline. When that belief weakens, adjustment becomes unavoidable. The arc of the pound sterling illustrates this principle with clarity. In the 19th century, sterling functioned as the backbone of global trade and finance. Central banks held it as a reserve. Contracts were settled in it. Capital flowed through it. After the World Wars, its role diminished, though it did not disappear. London adapted, reinventing itself as a flexible, globally connected financial center even without formal empire. Influence survived, but in altered form. The lesson is not one of simple collapse, but of transition. Across history, similar cycles can be observed. The Dutch Republic in the 17th century pioneered financial innovation and dominated European credit markets before yielding primacy. Britain followed, refining and expanding the model. Later, the United States would assume the central role in global finance. In each case, monetary leadership coincided with broader geopolitical influence. In each case, that cycles and structural shifts eventually altered the balance. What distinguishes financial empires from territorial ones is their invisibility. Borders are visible on maps, capital flows are not. Influence exercised through lending agreements, currency settlements, and financial regulation lacks the spectacle of conquest. Yet it can shape policy choices in distant capitals just as effectively. When empires learned to control wealth instead of land, they did not abandon power, they refined it. For contemporary observers of UK finance history and global monetary systems, the deeper pattern is unmistakable. Control over currency and credit extends influence beyond geography. But such control demands prudence. The temptation to rely on financial privilege, to borrow cheaply and consume more than is produced, carries long-term costs. The strength of a monetary empire ultimately depends on the credibility of its institutions and the productivity of its economy. Britain's